the American Chamber of Commerce on the economy and the budget 2021, challenges and prospects post-COVID-19, what businesses should expect. Today we have two exciting resource persons for you, Mr. Abeku, Gyan-Quansah, and Professor Eric Osei-Assibey. Abeku is from Pricewaterhouse, our partners for this event, and Professor Eric Osei-Assibey is an economist and an associate professor at the University of Ghana. Please let's welcome the Chamber's president, Madam Aisha Bedway, if she's on the call, to give us her opening remarks, and then we'll move over to Abeku for the presentation. Thank you very much. Over to you, Madam President.
Thank you very much. Good morning, Simon. Good morning to everybody on the call. Thank you so much for joining us to have this very important discussion. I'd like to thank Professor Osei-Assibey and my colleague, Abeku Gyan-Quansah, for agreeing to be part of this very important event. I'd urge you all to pay attention, and when the time comes to ask questions, please do, so we can have a great understanding of where we are as a country, particularly in this very challenging time for all of us as individuals and also businesses. And let's see what we can do to work together to move things forward for our country and for our businesses as well. So without taking much more of your time, I'll hand over back to Simon so we can start the discussion and the presentations. Thank you, and good morning once again.
Thank you very much, Madam President. That was short. It's as good as the coffee that we are getting this morning. So as we zoom in, as many of you are aware, and either you've been affected by COVID-19, I prefer to call it C-19, and it's been a very challenging a year and almost a half with COVID-19 on businesses. The UNDP and the World Bank have stated that about 770,000 workers have had salaries slashed, and about 42,000 have lost their jobs during this period. And so today, as we look at the economy and budget, prospects and challenges post-COVID-19, what businesses should expect, as I've already reiterated, we have two excellent resource persons for you. The man to handle the tax and government revenue and what businesses should expect by way of taxation and how they should go about it, and what government revenue would look like for this in this year's budget, is Mr. Abeku Gyan-Quansah. Abeku Gyan-Quansah is no stranger to the AmCham. He is a partner, a tax partner, as stated by my president at the Pricewaterhouse. He's an experienced consultant who has a demonstrated history of working in accounting and tax industry. He has over 14 years. That's 14 years. He looks young in the face, but he's very experienced in cash flows, tax preparation, tax consulting, analytical skills, and account reconciliation. He has a degree in economics and statistics, which is not an easy course, from Ghana's Premier University. He is also a fellow with the ACC of the UK. He's a fellow of the Chartered Institute of Accountants, Ghana. He has also done some work, or he's a fellow of the Chartered Institute of Taxation, Ghana, and has advanced diploma in international tax from the Chartered Institute of Taxation, UK. He's a pro-private sector person and one of, I must say, the most easily accessible persons with knowledge as to how the private sector can navigate this grotesque economy and often undefined tax policies that we are burdened with. So for those of you who don't know, he's also an expert on the Africa Continental Free Trade Area and has assisted many international companies to understand it. So ladies and gentlemen on the call, please let's welcome my good friend, Mr. Abeku Gyan-Quansah, the tax partner at Pricewaterhouse. Over to you, Mr. Abeku.
All right, so Simon and everyone, good morning. And sometimes when people read this profile, I wonder whether it's all about me. Everything to God's glory. Now, over the next few minutes, what I would attempt to do would be to share updates from the 2021 budget, with particular focus today on what businesses should expect. So you would realize that my focus today would not be too much on feedback to government, but rather on what we should do, assuming that Parliament approves the budget that was presented last week to Parliament. And by way of agenda, I'm going to be looking at 3 points. So I will give a brief background. And the whole idea of this background is for you to appreciate where government is coming from. As to whether or not we agree, those would be a matter for another day. 2, we'll look at the tax measures. And in these particular areas, the focus would be on what is the implications, or what are the implications of these tax measures on our businesses. And then I would end with some concluding remarks. So the background to this budget is that, assuming that Parliament approves the budget in the form that the President presented through the majority leader, or the leader of the majority group in Parliament, then government is saying that I expect that as a country, when we combine the incomes that we earn, we should have about 434 billion. We started this year, or we ended last year, with public debt of about 292 billion. And we expect that if everything goes as planned, we would have a deficit of 41.3 billion. This 41.3 billion is approximately 10% of the income, if everything goes as planned, that we would as a country generate. And one of the things that we need to note is that as a country, somewhere in 2008, we told ourselves that we would not spend more than 5% of the income that we earn as representing an overspend. So this is the background to the tax measures that we'll be discussing today. So in brief, we're expecting that as a country, we would raise revenues and we'll get some grants amounting to about 72.5 billion, and we would spend this year and pay for arrears prior to this year amounting to 113.8 billion. And the assumption, once again, is that Parliament, through the Appropriation Act of 2011, would approve this in its form. And if Parliament does that, as I'm saying, we expect that we would have a deficit of 41.3 billion. Now, on today's focus, what we're going to be looking at is the tax side. So the tax revenue side, government says that if everything goes as planned and Parliament approves the budget that I have presented, then I expect to raise net tax revenues of about 56 billion. Now, you would agree with me that these tax revenues would be coming from people like you, people like me, and those of us on this call. So we would have to contribute that 55 or 56 billion for the country to look at getting about 72 billion to run the affairs. And despite that, we expect that we'll end the year with deficit of about 41 billion. So having explained this context and having recognized that you and I would have to raise this 56 billion, what are the new measures that government is introducing this year to be able to reach the 56 billion? So in other words, this presentation is not going to make you an expert in tax, no, but it is going to assume that you already understand the old measures and you need to appreciate the impact of the new measures on your businesses. So moving forward, what are these tax measures that government is introducing? In the 2021 budget, government introduced, and according to PwC and how we've classified this, there are about 16 tax measures. And I know this may come as a surprise because people talk about just few of them, but there are about 16 tax measures that we need to note. 8 of those tax measures at a minimum would require some legislative changes. 8 of them, the other 8, some would require and some would not. All right. Whatever we're going to be talking about here would require Parliament to approve those tax measures, because our laws are clear that you cannot impose tax on the people unless the people's representatives, in this case, Parliament, approves that. The other takeaway point that we need to note is that anything that we're going to be talking about here would affect the budget that you have prepared for the year. So for those of you with a reporting date of 31st December, you probably drew your budget in November last year, October last year, worst case December last year. In drawing up those budgets, you had certain assumptions. Now, those assumptions need to be relooked at on the assumption that Parliament would approve the proposals that the President presented through the Leader of Parliament. Now, assuming the proposals are approved, what should you do? As I'm saying, the very first thing that you need to do is to take a second look at the budget that you prepared. Because the budget that you prepared for your companies had a certain assumption, and those assumptions may not hold at the time you were drawing up those budgets. The other thing that you need to note is that in Ghana, even though income taxes are computed by reference to a calendar year, we pay taxes for companies in quarterly basis. So what does that mean? What that means is that as you keep looking at how your businesses are run, and you keep looking at the assumptions under which the businesses are run, when those assumptions change, what it means is that you need to change this and know how much you'll be paying on quarterly basis. So the first takeaway point is that we need to go back and look at the budgets that we drew and ask ourselves whether the assumptions in those budgets are still relevant or need some adjustment. So what are the changes that government is proposing for 2011? First, there are 4 categories of relief that government is proposing for 2021. The first one relates to suspension on income tax that is paid by our small businesses through what we call the income tax stamps. As businesses registered with AmCham, you may not need to bother with that one. But then the second one, which relates to the suspension of income tax for trust and taxes, you may be bothered for the following reasons. One, some of you would probably have a basis for refunding or giving your employees transport claims. And you would probably say, when you travel this particular distance, this is what you can claim as a reimbursables. If the transport community or the trust and taxes respond positively to this, then one would say that you need to go back and you look at those numbers and see whether they are as reasonable as at the time you planned and what you currently have. If not, then maybe you need to revise it accordingly. But the interesting thing to note is that the taxes and trust or the GPRTU guys are already sounding warnings that they are going to increase their prices because of other measures that I'll be talking about soon. So what this definitely means is that if you had a certain amount that you had prescribed for your employees to be making claims, we need to go back and relook at those amounts because they may not be as realistic as at the time that you planned it. The other thing that we need to note is that when it comes to those of you who run businesses in the tourism sector or have schools or educational institutions that you run, government says that I'm going to give you a 30% rebate to help you relieve or get some relief from the negative impact of COVID-19. And by this, what government is saying is that payments that are due for second, third, and fourth quarters, if you have payment indeed to make, in other words, if you made profit sufficient enough to pay taxes, then there's going to be a 30% reduction in the amount that you pay to government. So what this means is that if your business is lucky enough to generate profits, before you write those checks to the GRA, if the laws are amended to support these particular proposals of government, then it means that do not just go and pay the full amount, but reduce it by 30% before you make those payments. The last relief that we need to take note of is that government is saying that I am going to now make gains that you make on trading securities on the Ghana Stock Exchange exempt from income tax. So if your company is listed on the Ghana Stock Exchange and people are trading in your shares, what it means is that when they dispose of shares on the Ghana Stock Exchange, the gains that they make would not be subject to income tax. So currently under our laws, if you make a gain on just trading shares which are not listed on the Ghana Stock Exchange, the law provides two approaches. One, either you include it as income and subject it to tax based on what your corporate income tax or your individual income tax rate is. Or two, if you're an individual, the law says that 15% of the amount that you have gained is what you would pay as taxes. What we need to note is that that 15% will not apply if those shares were listed on the Ghana Stock Exchange. A point to note is that this exemption that government is giving would effectively come in from 2022. And the reason why it will effectively come in from 2022 is that we currently have a law which exempts those gains up to the end of 2021. So effectively, this benefit would only be from 2022. The other thing that you need to note is that this exemption relates to capital gains made. It doesn't apply to return on your investment by way of dividends. So if your company is listed on the stock exchange and you are making dividend payments and the entities are subject to tax, it will still apply accordingly. For those of you into portfolio management, this may now be a reason to move your portfolio investment from, say, investment type A to the Ghana Stock Exchange, because now, if you are worried about the gains being made subject to tax from 2022, government is saying that you need not worry about that. So some businesses might already be thinking of, disposing of some of their shares so that by 2022, they don't have to pay tax. Now, there is no need to be worried about that. So these four categories are the relief that government is giving us for 2021. And what we need to note here is that the first two, and actually the third one, are very temporary measures. They are only meant for 2021. It is a GSC which goes beyond 2021. So having established this and having reminded you that take a second look at the budgets that you are drawing up, let me now go on and talk about the areas where government is saying, I would compensate for these reliefs by generating additional revenues. What are the areas? First, government says that there's going to be a 5% FinSec cleanup levy. So government is saying that, look, I've spent so much in cleaning up the financial sector. Based on the numbers that government have put out, government says that I've spent about 21 billion. I'm expecting to spend about 5 more billion to clean up the financial sector. I cannot continue doing this alone. I need more money. So I'm going to go to the banks. So what essentially this means for you is that if you are in Bank A, you must get interested in the activities of Bank B, because if Bank B collapses or government intervenes, your taxes may go up if government adopts this approach as banks collapse. So as banks, what you need to note is that previously, except for rural and commercial banks, banks, in addition to the 25% taxes that you paid on income, had to pay 5% on profit before tax as National Fiscal Stabilization Levy. There is now going to be an additional 5% coming in as FinSec cleanup levy. So if you have certain plans to pay dividends, please take note that those plans may change by virtue of this 5% stuff. And if you look at the 2021 budget, this measure would continue till 2024 until it's reviewed. So government has actually made budget plans for all of this. All right. Continuing, there are 3 additional measures that you must take note of. And these 3 additional measures are all indirect tax measures, measures that are not determined by reference to your profit determined over a period of time, but measures that affect you as and when you engage in transactions. So the first one the government is saying is that, look, I need money to clean up Ghana better. I had plans that I'll make Accra the cleanest city in Africa by a certain date. My plans are not going as expected, and therefore I need more money. So I am going to raise money from a sanitation and pollution levy of 10 pesos per liter of fuel, and the fuel here is petrol and diesel only, and 20% as energy sector recovery levy. So this means that in aggregate, 30 pesos would come on each liter. So for those of you who fill your tank per week, you may want to take a look at the things that run, and you will see that you may pay for about 50 liters when you fill your tank every week. So the 50 liters times 30 pesos would give you an idea of how much you'll be paying per week whenever you go and fill your tanks. So this 30 pesos is additional cost that would obviously come on you. So for those of you in mining, for example, you know that you pay a lot of amount or a lot of money to buy fuel for your operations. So straight away, the budgets that you drew up as fuel costs may have to be revised as soon as Parliament approves this. The other thing that government is saying is that, look, I need more money, and therefore I want to look at tax on e-commerce, or specifically e-services. So government is saying that I need money. There are a lot of transactions going on over the internet that currently I cannot tax. Now I need to enforce the provisions in my laws that says that these activities should give me tax income. So for those of you who are into e-commerce, who are dealing with entities abroad, it may not necessarily be on you directly, but those entities abroad would have to be registered for some taxes in Ghana and discharge those taxes accordingly. And the last thing that I want to talk about on this slide is the issue of government introducing a 1% COVID-19 health relief. And this COVID-19 health relief would be as follows. One, the National Fiscal Stabilization Levy, or the National Health Insurance Levy, which has a standard rate of 2.5, we're expecting that it would effectively go up to 3.5 effectively. And then we expect that the VAT flat rate scheme, which is currently 3%, would effectively go up to 4%. All these measures would obviously affect your businesses. So as you know already, the National Health Insurance Levy and the Ghana Education Trust Fund Levy are non-recoverable, even though they operate with VAT. So essentially what this means is that VAT, which is calculated according to the GRA on those levies, would now go up in addition to the levies going up. And based on our computation previously, the standard effective VAT rate was in total 18.125. This is now going to go up to 19.25. And 6% of that would not be recoverable. So you need to look at your plans again and begin planning and seeing the extent to which this affects your profits. By way of additional comment, I would now move on to the general administrative measures, which may or may not require legislative changes. So first, for those of you in gaming, government is saying that, look, I'm going to introduce policies for gaming. You may want to begin having conversations with your group, approach government, and participate in those conversations before you get measures which are at variance to your objectives. The other thing that government is saying is I'm going to deepen my digitization agenda. Of course, it's now a day for e-commerce. So government is going to improve on this. And as we have been saying, we may stop using the terminology tax identification number or TIN, and we may begin calling it GWEN, which is the Ghana Card Unique Identification Numbers. So please, let's take note of that. The other thing is that government is saying I'm going to intensify tax audits. So the encouragement to you is that you may want to look at your activities and make sure you are tax compliant before the revenue comes. And in addition, I'm going to look at the exemptions bill. And the exemptions bill basically is going to streamline the processes by which exemptions are granted in this country. So that if you want to get exemption, you now have a transparent way to approach and go through to get those exemptions. The other thing government is saying is that I'm going to introduce practice notes for transfer pricing and voluntary disclosure procedures. So transfer pricing basically applies when you deal with entities that are within the same group in broad terms. Government says that I revised the rules in 2020 November. I need to give people guidance on how to comply by way of practice notes. One of the things that we need to note is that practice notes are not binding on taxpayers, but of course, it gives you an idea of how GRA would approach issues. So it is very good to know what the GRA is thinking so that you can reduce dispute to the GRA. And closely linked to that is that if you are in the extractive sectors or you are in the downstream petroleum sector, government says that I am going to recover a lot more taxes from you because I believe there are so many things that are going on in that particular sector. The encouragement here is that as businesses, you may want to go ahead of government, engage consultants to review your books, make sure you are compliant before those audits are done and before you fall on the wrong side of the law. Closely linked to that is the issue of a temporary tax amnesty that government has introduced. And with respect to this tax amnesty, government is saying that if you owe me all your debts prior to 2020, the interest and penalties on those debts, I am prepared to waive them if you comply with your first quarter tax obligations. And what does your first quarter tax obligation include? It includes one, making sure that you have filed your self-assessment returns, making sure that your withholding taxes, your PAYE, your VAT, your withholding VAT, and all other taxes are complied with by the end of the first quarter. If you do that and you approach me, I would enter into a payment plan with you. And then by 30th of September, you should have settled all your liabilities. And if you do this, I would not impose penalties on you. For those of you who have gone through, in particular, custom audits, you know that the custom approach is typically to impose on you a penalty of 3 times or 300% of the liabilities that they usually would term as short collections when you are caught in an audit. So I would really encourage you that please take advantage of this particular measure and negotiate off any penalties and interest that you owe government to create shareholder value for your shareholders. Lastly, there is now a tax appeals board. I would actually want to go through AmCham to say that as businesses, we must be very interested in this appeals board and take advantage of it and even encourage government and support government to set it up quickly. What this tax appeals board will do is that if you have disputes to the GRA, currently you have to just go straight to the High Court. If this tax appeals board come into being, what it means that before you go to the High Court, at least you have an administrative body to listen. And the body is going to be composed as follows. One, there's a total, the board members will be 11, headed by a chairman, who should either be a retired Supreme Court judge or Court of Appeal judge, a High Court judge. And that person must have good knowledge in tax as the chairman. Then there will be 2 ex-GRA officials, retired, who will be part of the board. There will be 2 members of the Ghana Bar Association who will be part of the board. There will be 2 members from the Institute of Chartered Accountants who will be on the board, 2 members from the Chartered Institute of Taxation who will be on the board, and 2 women who will also be nominated onto the board. Now, currently, members of the Institute of Chartered Accountants and the tax profession would have the opportunity to nominate their own members. So at least 4 of them are going to be very independent, even though, yes, I know government have representation on these councils, but still the council are those who will nominate. So you know that 4 out of the 11 would solely be nominated by persons other than the minister responsible for finance. In addition, the board will sit as panel of 3 to deal with disputes. And from our perspective, we think that this would improve the transparency in the tax space, and therefore businesses, please take interest and support the creation of this particular board. The last 2 points I want to share here before I bring my presentation to a close is that government is saying that, look, I introduced for enforcement the National Pensions Act 2008 from 2010. I have noticed that a lot of businesses are not complying with the second-tier contribution, and I've dealt with a couple of cases where the penalties are quite huge. So government is saying that, look, I will start going after those who are not contributing. And one of the things that I've noticed from practice is that a lot of people who are for of this are those who are in the expatriate communities. Please, we need to note that our expatriates are not exempted from contributing to Ghana's national pension scheme. If the expatriate is beyond 45 years or older than 45 years at the time of registering on the scheme, what it means is that all the expatriate's contribution goes into the second tier. And when the expatriate is leaving Ghana, you go back to the second tier and you get all your money and you leave. The only exemption is if that expatriate would not be in Ghana for more than 3 years, and you've approached the national pensions regulator to get a letter confirming that indeed that expatriate should be exempt. And then the GRA2 has gone through a number of reforms. Now the MTOs, or the medium taxpayer offices, and the small taxpayers offices are no longer going to be called medium and small, but they're now going to be called taxpayer service centers. So please describe them as such. And these taxpayer service centers would operate under what we call area offices. And the area offices will now have centralized audit teams. So these centralized audit teams, you realize that your auditors will no longer come from your tax office. They will come from a centralized position, which means that they would be sharing a lot more ideas and they will become a lot more experienced. So we would really encourage you to step up on compliance so that you don't fall foul of the law. Concluding remarks, just to bring my session to a close. There are a number of documents you can get a lot more information from. So we have our 2021 budget highlights document. A simple Google search would pull out these documents, and then you can read a lot more into this thing that I've attempted to speak on in about 20 minutes from the documents. We also have our business school curriculum where you can always link up to us to get a lot more ideas on these tax matters. And then finally, we have a document which is free online where you can actually get information on taxation in Ghana. Just a Google search on PwC tax facts and figures, and you would also have that. So I wish to say thank you to AmCham for inviting us to speak, and I'm going to hand over to either Simon or to my professor when I was at the Faculty of Economics a number of years ago at Legon. Thank you very much.
Thank you. Thank you. Thank you very much, Mr. Abeku Gyan-Quansah. I'm sure you would all agree with me that this has been very informative, and the man is loaded with the stuff, so he's able to tell us what we have to do. So thank you very much. Our next resource person is Professor Eric Osei-Assibey. As Mr. Abeku said, he is an associate professor at the economics department and the dean of international programs at the University of Ghana. He's also a senior lecturer, and his area of specialty is in international development finance, where he has his PhD. He's also a postgraduate scholar at the Brown International Advanced Research Institute at Brown University, where he studied development and inequality in the Global South. He has published extensively on financial inclusion and microfinance and in many reputed journals, and has consulted for many international organizations. Ladies and gentlemen, if you are still online, please let's welcome Professor Eric Osei-Assibey, who would now take us through the economic policy of government. Over to you, Professor.
Thank you. Thank you very much for inviting me. It's a pleasure to be with you. And let me also thank Simon and thank Abeku for a very insightful presentation. I always maintain that Abeku should come back to the economics department as a professor.
I agree with you.
Yes, I think he's more of that than being in an accounting firm. Abeku, thank you for a very insightful presentation. So AmCham, thank you again for letting me into your space. So as you can see, my work is to actually take you through the main macroeconomic environment, government programs, macroeconomic objective, fiscal situation, debt situation, inflation, interest rates, and what have you. I think it's very important that as businesses, you tend to understand the business environment because your decisions actually will be underpinned by how the macroeconomic would behave. And so I think it's very important that you get to understand the key issues that could affect your businesses, although you may not have control over them, but it's always important that you understand how the economy is moving and how government policies can impact on your business. So the main outline that I will look at the medium-term policy objective of government, go through it quickly, and then we look at the real sector of the economy, economic growth, and then the various drivers of economic growth. We look at monetary developments, external sector development, fiscal development, and then I'll talk about some of the upside and downside risk to the projections that have been made in the budget. So by way of giving you the main objective or policy direction of government, as we know, the standing finance minister, Honorable Osei-Assibey, on the 12th of March, presented a budget. And in the budget, he made it clear that the government's medium-term macroeconomic policy objectives are likely to ensure strong macroeconomic fundamentals, sustain investment in productive infrastructure, which is key to underpin sustainable economic growth, develop a competitive world-class human capital, promote an efficient, well-capitalized financial sector, build a competitive business environment anchored on scientific and technological innovation, and then pursue a robust social protection system to take care of the vulnerable people in our society. The key to the country's recovery, we all know the extent to which the coronavirus affected our economy, disrupting the entire production value chain, people losing their job, government revenue falling, growth actually almost getting to a recession, and the entire social networks were actually, broken. So government is looking at how to speedily recover, and for government, the key issues that will underpin its recovery program one, as I mentioned earlier, to ensure macroeconomic stability. Of course, that is key, as well as debt sustainability, because if you don't achieve this one, there's no way you will be able to carry through your programs. Return to within the fiscal responsibility threshold of 5%. As a result of the COVID disruptions, government had to adjust its fiscal deficit, which was projected at 4.8. They had to adjust it to 11.4% because of shortfall in revenue and also ramp up in expenditure as a result of COVID-related health expenditures. And so that means that, as we know, we have the Fiscal Responsibility Act that put a cap of 5% on fiscal deficits yearly. And so that means that government would have to suspend that Fiscal Responsibility Act in order to accommodate more expenditures. And then implement reforms to increase revenue mobilization and efficiency. So the main objective of government is also to increase revenue and ensure public expenditure efficiency. These are key to create fiscal space for further expenditure and also to be able to reduce the fiscal deficit. Revitalize and transform the economy through the implementation of Ghana COVID-19 alleviation, revitalization and enterprise support program, what has become known as Ghana Cares. And this is a major intervention that government is seeking to pursue in the next couple of years. Government is seeking to actually raise 100 billion, and this 100 billion, 30 million, a billion is expected to come from government, and 70 billion is expected to come from you, the private sector. How that is going to be done is another question for different period. Build a robust financial sector to support growth and development. Yes, that is also necessary as a key enabler to provide access for private sector to invest. Provide a supportive private sector environment for entrepreneurship and domestic business and foreign direct investment to thrive. So create an enabling environment for private sector to thrive. Deepen structural reforms to make the machinery of government more efficient, and then also implement reforms to increase revenue mobilization, as I said. So these are the key programs and plans that underpin the 2021 budget. So these are what government intend to achieve in order to recover. We, as an economist, know that the road to recovery remains long, steep, and could also be bumpy because it's not that easy for us to come out given how we have fallen, particularly with the fiscal deficit and with growth. So now let me take you through the key trends and then the projections that have been made in the budget. And I'm going to start off with the real sector of the economy. When we talk about the real sector, we are actually looking at the supply side of the economy. For every economy, we have the supply side effect and then we have the demand side effect. The supply side effect is the output growth, and the demand side effect is the expenditure, government expenditure, macroeconomic, monetary policy, fiscal policy, external sector. Those are the supply, the demand side, because those policies affect demand directly. This one affects supply. And so each one of it is very important in macroeconomic management. Now, so first let's look at economic growth, which actually look at total production within the country in a year. So our total production, Ghana's growth is expected to actually increase more than it has been expected for the year 2021. If you see prior to the COVID, Ghana was doing quite well. We entered the year with a growth of around 6.5. So my red broken line is the non-oil GDP growth, and then the dark one is overall GDP growth. The non-oil GDP growth is actually a GDP without oil, and then the dark trend is the GDP with oil. Before the COVID 2019, we entered the year with growth of about 6.5%, and then non-oil real GDP growth is 5.8%. The reason why we are often interested in the non-oil is because the non-oil is largely driven by domestic factors, and which is more inclusive in the sense that it is driven by agriculture, manufacturing, construction, and others, which tend to employ the vast majority of the people. And then the non-oil is the one that is largely influenced by crude oil production. So we want to show the two to actually see how the economy or the economy's ability to generate more revenue as growth ensues. So we fell from this 6.5 to 0.9. That is at the end of 2020. This is just a projection, but that is how the economy may look. The reason, as we all know, is because of the COVID. We were just lucky that we did not slip to negative. And so we just escaped a recession. If we had gone into negative, that is when we'll be talking about a recession, that is output contraction. But we are just lucky we stayed above 0% growth. The non-oil GDP is actually 1.6, which is quite good. In the course of the year, though, in the second quarter, we actually recorded negative growth, which means that there was some contraction. What turned around was the fourth quarter of the year when the restrictions were eased, and so economic activity picked up. That ensured that we actually recorded positive growth of about 2.5. That brought us to 0.9 on the average. The expectation for this year, 2021, is that growth actually is expected to increase to 5%. And that is the oil GDP growth. Non-oil GDP growth is supposed to rise from 1.6 to 6.7%. That is huge jump. And one will wonder whether we will be able to achieve this kind of growth given the policy stance, the fiscal stance of government this year. And for the following years, actually, we expected that growth would average around 4.5 in the next 5 years. As a medium-term plan. So that is largely growth. Now, so what is this growth going to? What is going to be the key driver of this growth? So the key driver of the growth, as we often have, is the agriculture, industry, and then the services sector. The services sector, actually, which has often been the key driver of economic growth, that is the one in the pink. Yeah, you could see that it grew 15.7, 10.6, 7.6. This sector comprises the financial sector, communication sector, tourism, education, health, and trade, and all those services. And it constitutes about close to about 50% of our total GDP. For 2020, because of the disruption, tourism sector, hospitality sector collapsing, it grew just about 2.5. The hardest hit is the industrial sector, largely from the crude oil production, which recorded a negative growth of 2.5%. Going forward, we expect that agriculture to still maintain a very high growth of 4.4%. The industry to recover and grow by 4.8%, and then the service sector to grow by 5.6%. In terms of their contribution to GDP, that is the economic structure, we don't foresee much changes, or not much has changed in terms of the contribution of agri, and then industry, and then services. So the structure of the economy really over the last 5 years has not changed that much, and is not expected to change despite the growth rates changing. So what are the underlying risks? Is there a downside risk to the growth projection? We are projecting to grow at a robust rate of 5%. Is this going to be attainable? Yes and no. It depends on quite a number of factors. The key among them is the private consumption, and then private sector investments, as well as export growth. Private consumption, because it's a key component of aggregate demand. I mean, for you as business people, you expect your produce or your products to be purchased by consumers. And so if consumers do not have the appetite to spend, particularly if their disposable income is reduced, the fact that many people have lost their jobs and income levels reducing, definitely that will affect your production. And so one of the key things is that if we are able to recover from private consumption, obviously production will expand, and then we will be able to have the GDP that we are looking at. And also private sector investment, it remains key. Whether the private sector will have the appetite to expand their fiscal capital, to produce more, and also the key thing is whether they will have access to affordable credit because of the squeezed nature of their working capital as a result of the restrictions and other things that were imposed. And so investment by the private sector would be key for government to be able to realize the GDP growth. And the other thing is also about export growth, the increased value of commodity exports. And that this one is predicated largely on our trading partners' economy. If our trading partners, for example, US, Europe, EU, UK, and then East Asian Pacific, if they are able to recover quickly from the COVID disruptions, then we are likely to see some pickup in export growth. Otherwise, if there's going to be another resurgence or the vaccine distribution delays and they don't see enough quicker turnaround of the economy, that could significantly affect export growth. And also if the prices of crude oil, luckily we've seen some uptick in crude oil prices, that is quite good. We expect it to continue. Otherwise, that if anything affected and it begins to come down, that would also significantly affect growth. And that also includes gold and cocoa and others. So exports, this growth will also be underpinned largely by services exports. Services exports are actually tourism, hospitality industry, where people travel to access our services, hotels, restaurants, medical, education, and what have you. Because of the restriction, this sector is really not working. The growth has been predicated on the fact that there's going to be easiness in travel restrictions, and we are going to have tourism picking up again. If this doesn't happen, that could also confound the economic growth that we are expecting. And so, the key also to this growth is government's ability to spend as it has been projected in the budget, because government expenditure is often a stimulus. If a government is not able to spend, particularly on the infrastructure, that would also significantly affect the economic growth projections. So there is still some underlying or downside risk to this growth projection. So let's move to monetary and fiscal issues. So to a large extent, we think that government has managed the macroeconomic environment well, given the challenges that the COVID brought, and that I think is quite commendable. We saw inflation rising up sharply in June, July to about 11.4% as a result of the shutdown and then the supply chain disruption and all of that, puts pressure on demand, and that really increased prices. So, but since then, monetary policy and others had been engineered in such a way that it has led to inflation trending downwards to 8 medium-term targets. So inflation is now being targeted at 8 plus a -2. What it means is that it's anything between 6 and 10 is desirable. Okay, anything between 6 and 10 is desirable for the economy. And currently we are at 10.4, that is on the last reading. And so gradually inflation is trending up downwards. So once inflation is trending downward, we know we operate inflation targeting regime. That also often inform the central bank how it manipulates the monetary policy rates. And monetary policy rates are, as you know, as a result of the COVID, the government or the monetary authorities have been more accommodating, using more expansionary monetary policy. And so they actually reduce the policy rate from 16.5 to 16% to 14.5. That's 150 basis points. And that actually led to short-term interest rates reducing. So you look at these ones are interest rates. The short-term, the 91-day treasury bill rates reduced only marginally, but then thereafter it's been stable over the period. So also is 182-day treasury. We have had the same for 1 year treasury. But what is quite exciting is the fact that credit to the private sector has been on the decline actually since 2016, and that has now fallen from 31.7% to 21.1%. That is good news for the economy. So this is the monetary policy rate that has been falling, trending downwards. But the key question is the current lending rate, although it has been trending downwards, can't it go down further? In my view, yes. I think that it can because at the average rate of 22% is still high in the West African and African context. And so I believe that monetary policy rate, since we are having inflation trending downward, it provides enough latitude for the central bank to begin to trim the monetary policy rate. And it's also, it's justified in the sense that across the globe, you realize that all central banks, most central banks, should I say, are pursuing much more accommodative policies. Interest rates in developed countries are close to zero. And so that really affords us that opportunity for our central bank to reduce the policy rate. So I have always been saying that this is a unique opportunity for central bank to further reduce the policy rates from 14.5% to 13.5%. The difficulty on the part of central bank has been that, well, if we reduce it further, we are going to have what we call sell-off. Foreigners that hold our debts are going to sell the debt, and that can put pressure on our currency. So the currency will depreciate, and that will affect inflation again. That has been the main constraint. But I believe that the holders or the non-resident holders of our debts will not have much appetite to do so because there's not any profitable instruments, not much profitable instruments out there because of the COVID. Systemic risk across financial markets in the world is very high, and so there isn't going to be much appetite for that sell-off or sudden withdrawals. Exchange rate has performed quite well. In fact, the performance of the exchange rate for 2020 was one of the best in Africa. Depreciating just about 3.4% over the years, and that is the first time in about a decade. So that really has been good, and that has supported the relative stability that we are currently enjoying. The projection is that this year the depreciation will still be moderated in the sense that the domestic interest rates as it stands is going to be low. Central bank may not reduce the interest rates that much. Exports are expected to increase if everything goes as planned. And so we are expected to have a boost in exports if coronavirus do not rear its ugly head again, and the vaccination plan goes on as planned, then we're going to have much more exports. Government is looking to raise about 5 billion if the financial market condition is favorable. That will mean that there will be enough supply of dollar coming in. Already we have enough buffers, enough reserves, which I will show, supporting the the cedi. But that will also mean that Ghanaians' appetite for imported products will remain as it has been, that we don't import too many, which will put pressure on the dollar again. So the projection or the outlook for the year is one of a moderated depreciation, looking to have the cedi at the end of the year at 6 cedis 19 pesos. That is just an outlook. So like I said, external reserves, we have external reserves. We have been doing quite well despite the COVID. External reserves actually stand around 4 months of import cover. 4 months of import cover. That's about $8.8 billion. So it means that when we say import cover, what it means is that if all else fails, we have enough money to cater for our import for 4 months. And that really is what is supporting the currency. And also let's not forget that the central bank's policy shift of forward intervention, having forex, forward trading, and timely intervention into the market has also helped to manage speculation attacks on the cedi. So let's look at fiscal developments and outlook. So as you see, government's this year's budget is actually seeking to have some kind of fiscal consolidation, balancing that with a targeted sector-based fiscal stimulus packages and economic growth. The difficulties some of us have had, often when we talk about fiscal consolidation, it's about 2 things, right? It's about expenditure, government increasing, reducing its expenditure, or government increasing its revenue, or a combination of the two, often underlying fiscal consolidation. Government has clearly shown that it is moving into fiscal consolidation, in the sense that if you look at 2019, we were here, 4.7%. We jumped to about 11.7%. That is in terms of fiscal deficit. If government were to still continue to expand, have fiscal expansion, it would then be to increase this 11.7 further to say 14%. But this time around, government says no. Even though we need to spend to stimulate the economy, I would rather take the path of fiscal consolidation to reduce, to steer the economy back to 5% by the year 2024. So fiscal deficit is projected to actually increase just by 9.5. 9.5 is still high compared to 4.7, but it indicates government's desire to gradually come to a fiscal consolidation point. That means government reducing its rate of expenditure and increasing revenue through taxation, as Mr. Abeku mentioned. And so the difficulty is that often when government pursue fiscal consolidation, it tends to a large extent, particularly in the short run, undermine economic growth. Okay, and because governments will not be able to spend more, and as we know in economics, government expenditure is a stimulus. It stimulates the economy because government burden on infrastructure, paying workers well, and education, social protection, and others pump money. It's an injection into the economy, and that gives the increases consumption of households, and household investment increases, and businesses are able to expand. If government do not or does not spend that much, it affects these processes, and that means that economic growth becomes slower. And so there's that kind of inconsistency there. But in the medium to short term, fiscal consolidation is very consistent with economic growth, and that is what government mind is. Government is looking to medium to long term sustainable economic growth. So mean that in this year, the economy is likely to suffer in the next 2-3 years because of these fiscal consolidation measures that would, to a large extent, tend to confound growth. But at the same time, too, government is looking to stimulate the economy, particularly with the Ghana Cares program, if it's government is able to roll it out as suspected and is able to make the money, and also some stimulus packages, selected stimulus packages for some sectors that have been hard hit by the coronavirus. If those things happen and private sector is also able to respond, then there's going to be that balance. We will be able to get the 5% the robust 5% economic growth. But this shows that there is some tight belting that we need to tighten our belts because government expenditure will not come in as is expected. So in terms of government expenditure, like government is doing this because of the rigidity in the government budget. And this shows just about 3 expenditure items of government budget. I will talk more about this. The 3 expenditure items of government budget, which comprises compensation, including wages and salaries, interest payments, that is the interest that we pay on our debt, and then statutory payments, that is transfers to government agencies that have been legislated. So all of these 3, often in economics, we call them non-discretionary expenditures. They are earmarked funds or expenditures that government cannot touch per law or per the agreement. Government will definitely have to pay workers. If workers are not paid, it's obviously going to create chaos. Interest payment, the debt that you have contracted, you have to pay. Statutory payments are legislated, and so unless you want to flout the law, otherwise you have to pay. When you look at these 3 items and you take it as percentage of domestic tax revenue, 2020, it is actually close to about 120% of domestic revenue. Just these 3 items. CAPEX has not come, capital expenditure has not come, goods and services have not come. And so clearly from the word go, government is starting at a deficit. It means that if we don't borrow, we will not be able to spend on key capital expenditures in social sectors of the economy. So that's how rigid the budget is. So 2021 budget is distributed in terms of revenue. Tax revenue, as Mr. Quansah said, is about 55 billion and in this order. So really we've spoken about this, so I'll just jump over. And then this is how tax revenue is going to increase. You've heard a lot about tax revenue. So expenditure distribution is this way. So we have the compensation, as I spoke about, which is about 30 billion. We have the interest payments, which is about 35 billion. We have, this is the statutory payments, grants to other government units, which is about 18 billion. It is these 3, 1, 2, 3, that I said that it constitutes about 120% of tax revenue. And all these rest, the capital expenditure, goods and services, other expenditures, arrears, for government to be able to pay this, it has to borrow. And that is the reality. And one thing about our budget, our government budget, is also the fact that it is still very heavy on social expenditure. Okay, so the budget can further be distributed into administration, economic, infrastructure, social, public safety. Okay, beyond what we pay for interest payments and others, you can look at budget from this front. And if you look at social, which include healthcare spending, education spending, social protection spending, that alone takes a chunk of government expenditure, this social spending. And this is where the problem is. And this is why sometimes it is justified for government to increase the tax payments, because for countries across the globe where their budget is very much heavy on social spending, their tax to GDP is often higher. It ranges between 30 to 45% because you need tax. Somebody will have to pay for this. And so for us here, where our tax to GDP is just about 13%, that really explains why government must always borrow to be able to meet the budget. So now, government have to borrow. And because of this situation of high social spending, which often do not translate into immediate economic growth, government must always have to borrow. And over the period, you see the trends in borrowing. Government borrowing has been increasing. So in terms of GDP growth, which I've shown the trend here, in 2017, it was 57.3% of GDP. We increased to 59.3%. We last 2019 was 62.4%, and then a jump to 76.1%. This is a quantum jump, and this is as a result of three key factors according to government. This is COVID-related expenditures that is adding about 40 billion to our debts. We have about the financial sector cleanup adding about 21 billion. We have the charges, the capacity, excess capacity charges to IPP contributing about 18 billion or thereabout. So together, that brings the debt to GDP of about 76.1% of GDP. That is about 291 billion Ghana cedis. So without that, if those three are not added, our debt to GDP would have been 58.7%. Now, mind you, from this point to this point are all based on the rebate. Had it not been for the rebate that was carried out in 2016, this would have been the trend, 70, 71, and then would have been going up and up and up. But for the rebasing, we were able to moderate it, bring it down, and then we are rising again. Okay. For comparative to other countries in West Africa, public debt to GDP for Nigeria is 36.8%. For Cote d'Ivoire is 53.9%. All right. So the knock-on effect of all this public debt, and the reason why we talk so much about the public debt is the fact that it constrains government ability to spend on the critical sectors of the economy that would drive economic growth. Okay, so because once you're contracting more debts, what that means is that your interest payment would also be increasing. So that is your cost of servicing the debt. And over the years, over the last couple of years, 7 years, you could see that the interest payment has overtaken capital expenditure. And there's no hope in sight that we're actually bringing this down. So while capital expenditure is on the downward trend, we picked up quite a bit in 2019 to 3.1, but it's projected to fall to 2.6%. At the same time, interest payment is increasing and keep increasing. It's now at 8.3 of GDP. So since this one is discretionary expense, government often stepped aside its capital expenditure in favor of interest payments. And that means that the road network and the energy sector investment and others will not happen. And so we tend to have huge gap in the road network, in the housing and others that really will drive economic growth. And so the key reason why we borrow, like I mentioned earlier, is the fact that our tax to GDP remains very low. And this you compare to other comparator countries, peer countries in the country, and you see that this has been very low, at 12.2% compared to Lesotho, 35%. So key initiative for government or government seeking to quicken recovery, I'm just finishing, I'm almost done, is implementing the Agenda 111. That is building hospitals in each of the districts that we have, scale up the vaccination of Ghanaians. which is key to ensure ahead mobility that will bring the economy back to normal. Continuing with the planting for food and job, which underlines agricultural projection. If this do not happen, then we are in trouble. Implement the Ghana Care program. The key question is, where is the 100 billion going to come from? And then implement COVID-19 social programs, continue with the free senior high school, improve public sanitation, deploy resources, security, and continue with the one factory, one agenda. All of this is expected to cost the country about 48 billion. Our tax projection is about 55 billion. So just this one alone takes about 48 billion. So really, that is a tall order for government. But if these investments don't happen, then be rest assured that we are not going to see the growth that is expected. So I will just end here. I wanted to take you through the SWOT situation, but let me end here. Thank you very much. I'll just stand by for your question. Thank you.
Thank you, Professor Eric Osei-Assibey, for that presentation. It's very detailed. Do we have any questions? I think that mainly what we've seen in the chat box is about having access to the presentation. We can assure you that this has been recorded. So for all those of you that we have your email address, you would get the recording to listen to it once again. Is there any question? We have time for just about a question or two.
I have a question, Mr.
All right.
Simon.
Your name and where
my name is Isaac Eduhine Opoku.
Okay.
I think he made mention of what do you call it? The tax bracket being 30 to 40%. So how do you justify, the 30 to 40%? Because if somebody, when you look at the U.S. system, is we have from a 12 to 32% depending on your annual income, right? So the question is, with the 30 to 40%, on what bracket, is this kind of tax being structured? Because we have different income bracket for other people. So how do the government justify the 30 to 40%?
All right.
It is for
yes, I think that he's requiring the two of you to stand in the position of government and explain to him the rationale behind the 30 to 40%. Is Mr. Abeku with us?
Simon, I'm here. I'm just thinking of.
You're also thinking about it.
To 40, about where the 30 and 40 is coming. But just to explain, for resident individuals in Ghana, the income tax bands, just as you may find in other countries, starts from 0 up to a maximum of 30%. And then for companies in general, the tax rate is 25%. With those who are required to pay the National Fiscal Stabilization Levy, you have an extra 5%. And now that for banks, we're going to see a FinSec levy, you may effectively see another 5%. So that would get you roughly into 35%, which is obviously between maybe 30 and 40%. Now, when it comes to tax design, and I'm sure Prof will be able to speak to this more than I can, there are so many things that goes into tax design. So the US may have certain rates, as the one asking the questions have talked about, but obviously we are not at the level of development of the US. And as in whether we can design to pick up the same 12 or so percentages that the US has, we may not be there yet. So we would probably just, for now, trust that those who are in our tax policy units have modeled it properly and recognize that the various tax rates that we currently have in Ghana is something which is optimal enough for us to earn the kind of revenues that we are earning. But me not being in tax policy, one thing that I find a bit difficult to appreciate is why the individual tax rate should have a top number higher than the general corporate income tax rate. So even without going into detail and looking at the numbers, I would ask myself, why would you want to put up the tax rate of an individual higher than the tax rate of a company? When even in the case of companies will have so many deductions to reduce their taxable income, and individuals may not have that. And let's not forget, when I talk about individuals, I'm not just looking at an individual as an employee. I'm looking at an individual even running a sole proprietorship business, and that will still have a higher rate than a company. And hopefully, government will go back to the level where we didn't have this anomaly, if I call it that way. So Simon, that will be my answer to the question. We must always look at the development stage of a country to design their tax rates. And until we are able to see the basis which support why our tax structure is different from what the US has, it will be very difficult to provide a response. Thanks.
Thank you. I don't know if, Professor, you may want to add a word or this should suffice.
Because Mr. Simon, I asked that question because, a lot of people don't pay taxes because of, the tax burden that is imposed on them, right? And under normal circumstances, when you look at the numbers, when you look at, business structures, you want to make tax, the levies more, reasonable, so that it will encourage people to basically pay taxes. At the same time, when you burden them with a lot of taxes, like a 30 to 40%, it's going towards the ordinary person. It's not going to the corporate. So we end up burdening the ordinary citizen, right? So they are the people buying. They are our customers. So at the end of the day, we really have to look at the numbers, because everything is about the numbers to determine, something that will be more reasonable, ease the burden on the, ordinary person.
Great. So thank you very much, Mr. Isaac Eduhine. We have, yes, Mr. Isaac Eduhine, we have with us, if we can take some closing remarks from our president, Madam Aisha Bedwe. But before that, I would like to say a special thanks to you, Mr. Abeku, Gyan-Quansah, who is a tax partner at Pricewaterhouse, and also to Professor Eric Osei-Assibey. Thank you very much. Your presentation today has been extremely helpful and very, very useful, and we will definitely get in touch with you. So let me please hand you over to the President of the Chamber, Madam Aisha Bedwe, to give us her closing remarks. Over to you, Madam President.
Thank you very much, Simon. I'd like to say a special thank you to both our facilitators, so my colleague Abeku and Professor Osei-Assibey. I think it was a very educational and informative session. It helped us understand, I guess, the logic or the thinking behind government's policies. We may not like it, but this is what we are. This is what we are faced with, and it's better that we are prepared as much as possible, so we can make the decisions that we need to make sure our businesses and even our homes run effectively within the current situation and scenarios. So I want to say thank you once again to both facilitators, and thank you to everybody who joined. I've seen all the comments. Thank you for being attentive and also participating. Like we've said earlier, this session has been recorded, so you can come back to it to have a deeper appreciation and understanding. And both facilitators are available if you want to contact them for further questions, or you can do that through us at the chamber, and we'll be happy to filter them through. So thank you once again. Let's keep working together to build, a stronger economy and do the best we can do with what we have been given at this point in time. It's challenging for everybody, but I believe that we will, get through this as well. To quote our president, the battle is the Lord's. So thank you once again. Wishing everybody a wonderful day and week ahead. Thank you.
Thank you, Madam President. So thank you all. We will see you on the next webinar, and that will be announced very soon. So thank you for coming, and please do have a great day. we'll send the materials to you, and thank you very much. So God bless you. Thank you. Bye-bye.